Welcome back, everyone. Okay, let's dive right into this because today's explainer is an absolute must-hear. We're looking at some incredibly stark warnings from best-selling personal finance author Dave Ramsey. He's officially warning Americans about some massive 401k and IRA mistakes that, frankly, way too many of us are making without even realizing it. And the financial consequences of these errors, they can be absolutely devastating to your future nest egg. We're going to break down exactly what these blunders are and, more importantly, how you can avoid them.
Here is our roadmap for today's explainer. 1. The early withdrawal disaster. 2. 401k loans and hardships. 3. The million-dollar tax trap. And 4. The 8% withdrawal debate.
All right, kicking things off with Section 1. The early withdrawal disaster. Robbing your current and future self.
According to recent data, early 401k withdrawals have actually hit a record high recently. When a financial emergency strikes, maybe a sudden medical bill or, heaven forbid, a job loss, it is so incredibly tempting to look at your retirement account and just treat your 401k like a giant emergency ATM. But Ramsey warns that taking an early withdrawal before age 59 and a half is quite literally one of the absolute worst moves you can make. The sheer financial pain of this mistake hits you instantly. Let's walk through this brutal math step by step. Say you make $60,000 a year, which puts you in the 22% tax bracket, and you decide to withdraw $20,000 from your traditional 401k to cover some bills. Well, Uncle Sam immediately takes 22% for income taxes, so that's $4,400 just gone. But wait, since you're under 59 and a half, you also get slapped with a 10% early withdrawal penalty. Bam, another $2,000 gone. Your $20,000 withdrawal instantly shrinks to just $13,600 in net cash. You have instantly lost roughly 1/3 of your money just for touching it.
But the tax penalty is honestly just half the tragedy here. Consider this number, $300,000. If you had just left that initial $20,000 alone for 25 years, invested in good growth stock mutual funds, averaging an 11% return, it could have grown to over $300,000. By taking that cash out today, you are severely robbing your future self of hundreds of thousands of dollars in compound growth. It's like chopping down an apple tree before it ever has a chance to produce a single piece of fruit.
Moving right along to Section 2, 401k loans and hardships. The hidden traps of borrowing your own money.
So a lot of people see the math on that early cash out and think, okay, I won't do a standard withdrawal. I'll just take out a 401k loan or maybe a hardship withdrawal instead. That's a totally safe alternative, right? Actually wrong. On the surface, a 401k loan sounds harmless because you're just borrowing from yourself. But first off, it is treated as a debt that you legally have to repay, usually within 5 years. Secondly, there is this massive double taxation trap. See, you are repaying that loan using after-tax dollars from your current paycheck. But because it's going back into a pre-tax traditional 401k, you are going to be taxed on that exact same money again when you withdraw it in retirement. And the most catastrophic risk is the third point. If you suddenly lose your job, leave your job, or get laid off, that entire loan balance is generally due by the following year's tax day. If you can't pay it, the unpaid loan defaults right into a penalized early withdrawal, hitting you with those exact same taxes and 10% penalties we just talked about. So the crucial point is that tapping your retirement should never, ever be your backup plan. Ramsey explicitly states that the only time you should ever touch a 401k early is to avoid bankruptcy or foreclosure, and only after you've exhausted literally everything else. Instead, he highly recommends these baby step alternatives. Step 1. Go into conserve mode, get on a super strict budget, and cut all unnecessary spending. Step 2. Get on the phone with your lenders or the IRS and work out a payment plan. Step 3. Ask family or friends for non-monetary help, like maybe watching the kids so you can save on childcare. And Step 4. Take on extra work or a side hustle to boost your income. A temporary sacrifice beats permanent retirement damage for sure every single time.
All right, Section 3, the million-dollar tax trap, taxing the seed versus taxing the harvest. Now we're shifting our focus a bit from accumulation mistakes, like taking those early withdrawals, to account structure choices. Are you making a $1 million mistake with your 401k elections? It is a phenomenal question. There was a 40-year-old caller who recently phoned into the Ramsey Show, and she was maxing out her 401k at $24,000 a year. Amazing, right? But she had this nagging feeling because her financial advisor had explicitly told her to stop funding her Roth 401k and redirect all that money into a traditional 401k just to chase an immediate, short-term tax deduction.
Well, Ramsey's reaction to this advisor's advice was absolutely blunt. He told her,
I'm flabbergasted that somebody could be this dumb and call themselves a financial advisor. I mean, he didn't hold back at all. He told her to fire the advisor immediately because chasing that current year tax deduction was going to cost her a fortune down the road. Let's look at exactly why he was so incredibly shocked by this recommendation.
And this brilliantly illustrates exactly what is at stake here. Let's say over a 25-year runway, contributing $24,000 a year equals about $600,000 in total contributions. We'll call that your seed. Now with standard growth, that account could reach $3.1 million, meaning you have $2.5 million in pure growth. That is your harvest. With a traditional 401k, you get a tax deduction on the $600,000 seed today, yeah, but you have to pay income taxes on that massive $2.5 million harvest in retirement. With a Roth, you pay taxes on the $600,000 seed today, but the entire $2.5 million harvest is completely tax-free. Just as Ramsey pointed out, the advisor was basically telling her to save taxes on the $600,000, but in exchange, volunteering to pay taxes on $2.5 million. It's a fundamental mathematical error that literally costs hundreds of thousands of dollars.
Which brings us to Section 4, the 8% withdrawal debate, the controversial retirement endgame.
So you've successfully protected your 401k from early withdrawals, you've chosen the right Roth structure, but what happens when you actually retire? How much money can you safely take out of your accounts each year without, going broke? Well, to understand this debate, we first have to clearly define a really critical concept: sequence of return risk. This is the danger that the timing of poor investment returns, like a massive stock market slump happening right at the beginning of your retirement, will permanently damage how long your savings will actually last. See, when you're withdrawing money while the market is down, you are selling shares at a loss, and those shares just aren't there to recover when the market bounces back. This specific concept is the core argument used by critics against overly optimistic withdrawal plans.
And right here is where the massive controversy lies. On one side, we have Ramsey's rule. A caller asked what percentage of his assets he should withdraw in retirement, and Ramsey stated he is perfectly comfortable with an 8% withdrawal rate. His straightforward math is that a portfolio heavily invested in mutual funds makes a 12% average return minus a 4% inflation rate, leaving you with a perfectly safe 8% to live on. But on the other side of the aisle, critics like personal finance authors Rob Berger and Dave McKnight call this advice pretty dangerous. They point out that the historical compound annual growth rate, or CAGR, for U.S. stocks is actually closer to 10.25%. And more importantly, they argue Ramsey's simple subtraction completely ignores the real-world reality of sequence of return risk. The critics' point is that just because a market averages a certain return over 30 years, it doesn't mean you get that exact return every single year. If you take out 8% during a multi-year market downturn, your portfolio could genuinely collapse. It's a really fascinating clash between simple, aggressive optimism and cautious, volatility-adjusted planning.
But let's actually pivot the narrative away from the pure math for a second, because at the end of the day, retirement isn't just about spreadsheets and withdrawal rates, right? It is deeply human. In an email to the street, Ramsey shared this incredible quote. He said, "Contentment has nothing to do with how many hours you work or how many zeros are in your bank account." He warns that some people get so obsessed with endlessly accumulating wealth that they actually surrender the joy in their current lives just to increase an already secure balance.
Which leaves us with this final, incredibly provocative question to end on. Are you sacrificing your present joy just to increase an already secure balance, or are you prioritizing true contentment? We've talked about all the mechanics today: avoiding those brutal early withdrawals, skipping the 401k loans, optimizing your Roth tax strategy, and understanding the nuances of withdrawal rate math. But all of these financial mechanics are simply tools, and they're designed to help you live a good life. Don't compromise your daily happiness just to pad a spreadsheet. Evaluate your own baseline, avoid the major mistakes we've outlined today, and build a retirement that brings you true peace of mind. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll catch you next time.